If you're in business for yourself and you're organized as either a sole proprietor or a single member LLC and you're filing on Schedule C of Form 1040, you could be paying too much in taxes. But I'm going to show you through how making the S Corp election, you can unlock 5 ways to potentially save thousands of dollars on taxes. Let's get to it. Welcome to Tax Chit Chat, the place where we talk all things tax all the time. So the first way that we're going to talk about is through the Elimination of Self-Employment Tax. So just about everybody knows, you can go and look on any other YouTube video, that by forming an S corporation or making the S Corp election, they're not going to pay any self-employment tax. But what I want to do is I want to go through a detailed example so you can see the magnitude of exactly what making this election can do. All right. So let's assume that we have an individual that makes $100,000. And currently they have a single member LLC, which we know is going to file on Schedule C. As we can see in this example, they have $100,000 worth of business profit. They're going to get some deductions for self-employment tax. They're going to get the standard deduction, which is going to make it simple versus them taking the itemized deduction. And they're also going to get the 20% qualified business income deduction, or the QBI deduction. So what they're going to wind up with is a taxable income of $62,668. Now, what's important here is that they're going to pay 2 types of tax. The first is going to be income tax, but the second is going to be self-employment tax. Now, the thing to know about self-employment tax is that when you work a job and you receive a W-2, there are 4 types of taxes that potentially come out of your pay, okay? You can elect 2 of them. The first is you can elect to have federal income taxes taken out if you live in a taxable state. I can also elect to take out state income taxes. But then there's 2 taxes that I can't control. The first is Social Security tax, and then the other is Medicare, okay? And these 2 taxes, roughly 7.65%, I can't control them. They have to come out. But what you don't know is that the employer, in this case, Wilson Rogers Company, because we're talking about JIRA's W-2 here on the screen, they go ahead and they take out and they match that other percentage. So it's like 15% of taxes that ended up coming out, all right? So we can see here on a W-2 with $100,000 in salary, there's $7,650 in Social Security and Medicare taxes being taken out, and then the employer is going to match the other half, so that's going to be $15,300, okay? But as a self-employed person, you pay both of those pieces of taxes, both the employee and the employer side. So looking at this example, this person is going to pay $8,840 of income tax, and then they're going to pay a whopping $14,130 worth of self-employment tax for a total of $22,970 in tax. Now, by simply filing the S Corp election, look at what happens. Most of this scenario stays the same. There's $100,000 worth of income. The standard deduction is the same. The QBI deduction goes up a little bit, and they wind up with taxable income of $68,320. Their income tax is going to be $10,083. But what's missing? There's no self-employment tax. So the total amount of tax that the person is going to pay if they have an S Corp is going to be $10,083. By making the S Corp election, this person has saved almost $13,000. And that's the thing. S Corps are not subject to self-employment tax. They are pass-throughs, just like a Schedule C or a sole proprietor. You pay the tax on your individual tax return, but you're not going to be subject to self-employment tax. So that's the first way that you could save. Now, there is a caveat, okay? The IRS does have rules around reasonable compensation. So that means that a person who is an S Corp owner does have to put themselves on payroll and pay themselves a reasonable compensation, all right? It's a little bit beyond the scope of this video right here, but if you're interested in about reasonable compensation and you want to know more about it and you'd like us to make a video about it, then go ahead and drop a comment down below. So the second way that a person with an S Corp can save is through employer-sponsored retirement plans. And I'm talking about things like either a 401k or a defined benefit plan, such as like a pension. We all know if we work a job, you can contribute to a 401k, so that's coming out of the employee's pay. But as an employer, you can do things like offer a match, and that match is a write-off for the company. Let's say that you offer a pension. The cost of maintaining that pension is a write-off for the business. So if you wanted to do things like contribute to your employees' well-being and their retirement, you can potentially receive a write-off. Now, our next option is very similar to this option. It's retirement plan related, but it is through increased retirement plan contributions. So specifically what I'm talking about is like SEP IRA contributions. Now, I can hear all the other accountants out there who may watch this video say, yeah, but you can make a SEP contribution if you're a sole proprietor or if you have, a single member LLC. But yes, you also know that the contribution limits are completely different, okay? So with a single member LLC or somebody filing on a Schedule C, you can contribute up to a maximum, effectively, 20% of the profit of your business to a SEP IRA. But that number changes and it becomes 25% when you are talking about a company like an S Corp and making those contributions. Now, the catch is that 25% is related to your W-2 compensation. So that means that you actually have to pay yourself enough in order to potentially max out the contribution. And in 2024, that amount is $69,000. The other thing to note is that it is actually the business is making that contribution. So the business is going to make that contribution to your SEP IRA, and then they're going to take the write-off for it. So they can potentially give you $69,000 into your retirement plan, and then they can write that off on their tax return, which is, of course, lowering the profitability that is then coming over on the K-1 that you ultimately have to pay taxes on. Now, before we get to our last two tips, if you're thinking about making an S Corp election, but you're kind of like, I think I may have made it too late, then make sure you go and you check out this video, because in it, we talk about how I've helped dozens of corporations make the late S Corp election. Yes, you have up to 3 years and 75 days to make a S Corp election and have it be effective. So if you think that you should have been an S Corp and you want to potentially make an S Corp election, it could still be possible. And right now in that video, I talk about how we've been batting over 1,000. And knock on wood, I get to keep my batting average over 1,000. So yes, we're perfect in getting late S Corp elections accepted. The other thing you can do is you can head on over to our blog and you can check out either the S Corp automobile deduction or the S Corp home office deduction post. In both posts, we talk about the S Corp tax reduction analysis. This is where we analyze your business situation and see if making the S Corp election can save you thousands in taxes. Both blog posts are listed in the description of this video, so make sure you go ahead and you check those out. So the fourth way that an S Corp can help you save on taxes is through what's known as income shifting. So let's say that, in our particular example, the individual was single, but let's say that they were a parent. The child just lives with the other parent, I should say. They contribute to their child, they pay for things, and they help support them financially, okay? So in this particular instance, if you are giving money to your child that you're going to have to pay, how's that we can potentially make that a tax write-off? By putting your child on payroll. So if that kid is of working age, they can go on payroll, they can do work, and you can compensate them. What does that do? That is a write-off salary. It's a write-off for the business. They get to write that off. The child then has income that they can use to potentially pay for things. They can help. It gives them income so that they can contribute to things such as their own retirement plans, like an IRA or a Roth IRA. And if their income is below the standard deduction, they won't even have to pay income taxes on it. So through income shifting, what you can do is income that was going to go to your child, who is potentially going to be in a lower tax bracket than what you are, helps reduce the tax burden of the S Corp, because you get to write that off, that expense off on that S Corp return, which once again, the profit flows through to your personal return, thereby reducing your taxable income. And the fifth and final way that we're going to talk about is through fringe benefits. All right, so S corporations can offer things like employee reimbursement, they can do educational reimbursement, they can do dependent and child care expenses, they can offer all those fringe benefits to their employees. And those benefits, while they're not taxable to the employee, or they're usually not taxable to the employee, they are write-offs for the corporation. So if you have employees and your corporation is big enough, you can go ahead and offer those things as an S Corp, write them off, once again, reducing your taxable income, and therefore also giving a benefit to your employees. Now, if you like this video and you got some value from it, then please consider giving it a thumbs up, or you can say thanks by buying us a coffee. The link's in the description below, and the extra coins go towards helping us make future videos and pay for things like gear and props. So, until we meet again, remember to keep earning, keep learning, and just like that, this chat is adjourned.